Hello everyone, welcome back to the channel. Today we are going to decide some of the most important basic rules of accounting, that is accounting concepts and conventions. Okay, this material is specifically designed for you even if you have never studied commerce. Okay, right, let's just start off. Firstly, okay, you might be thinking, why do I need to know this? Well, understanding these basic rules basically helps you make sense of the world around you. When you read about a company's, say, profit or losses, these rules explain how they measured that. If you invest or work for a company or even run a small side hustle, knowing the basics helps you understand the financial health. Okay, think of it as learning the grammar of the language of business. Understand? Okay, concepts and conventions. Now, what are concepts and conventions? Simply put, they are the rules of the game for accounting. Okay, now concepts are like the fundamental rules, the absolute basics everyone agrees on before starting. It's like, if you're watching IPL now, everyone agrees on a boundary line. If someone hits a full toss over the boundary line, it's a sixer. That's a rule. Okay, so those are concepts, basic rules which everyone agrees on. Next, conventions. Now conventions are most like the practical guidelines or best practices that have developed over time to make the game fair and the results understandable. Okay, so I can't give you what fair means, but yes, shaking hands after a match can be a fair convention rule. These are conventions. Okay, they are like unspoken rules in traffic. Okay, that is what it is. Now let's dive into the key one, starting with the foundation of concepts. Okay, business entity concept. First up, business entity concept. Now this is super important. It just means that the business is treated as completely separate from its owner. Now imagine your local tailor. The money in the shop's cash belongs to the business. Okay, but the money in the tailor's wallet or person pocket is theirs. It's completely different. Okay, if you take a bakery or any shop, okay, the owner's money is owner's money, but the business's money is business's money. Now we keep them separate to see if the business itself is making money, not just whether the owner is rich or poor. Okay, it's a different, completely different. Reliance Ambani might be, multi-millionaire, multi-billionaire, but if he is starting one company, that company's account is completely different. So it's business entity concept. The owner is different from the business. The business as a separate entity altogether. That is business entity concept. Now, next one is money measurement concept. Okay. Now accounting only records things that can be expressed in terms of money, like say rupees, dollars, euros, etc. So a company can record buying a delivery van for say 8 lakh rupees or 10 lakh rupees. Okay, but we can't really record a great employees teamwork. Okay, in the main financial books. Team value is very, very valuable, but we can't actually put money on it. That is the reason we can't record it. So money measurement concept is basically we can record only which is valued in terms of money. Okay, only reason is because it's hard to put a reliable rupee value on it. Okay, the reason for this is this keeps accounting focused on objective, that is financial data. Okay, that is money measurement concept. Now, okay, now going concern concept. There is this going concern concept. Now this is an assumption that the business will keep operating into the future. It's not expected to shut down tomorrow. Now think about it. When, for example, Infosys or Reliance or our own university, Andhra University, builds a new campus, we don't value it based on selling the bricks just tomorrow. No, okay. The value is based on its use for years to come, because they assume they will be operating for years. Okay, that is the going concern concept. This basically impacts how assets are valued and justifies long-term planning. That is about going concern concept. Okay, now the next one is the accounting period concept. Now, how do we know that the business is doing well? We do need regular checkups, right? That is the accounting period concept. Now, how do you know that you are doing good in your BCom? While you are doing your BCom, 3-year BCom, how do we know that you are doing good? We put your exams like SEM 1, SEM 2, first year exams, internals, externals, right? That is what accounting period concept is. Okay, the long life of a business is basically broken down into shorter consistent periods, usually generally 1 year. Okay, like in India the financial year is from April 1st to 31st March, but sometimes even quarters or months. Okay, this basically allows businesses, owners and investors to regularly check the performance and compare results over time. Okay, it's like getting your exam results every semester, where you understand, okay, you are doing good or not. To know whether you are doing good or not, we need to conduct exams on different periods. So that is the accounting period concept. Next is the cost concept. This is also called the historical cost principle. This says that the assets are generally recorded at their original purchase price. Okay, we record the assets at original purchase price, not at present value. For example, if a company has bought a land say 10 years ago for say 20 lakhs, in the accounting books it will be recorded as 20 lakhs. Even today, if today it's worth 1 crore, we do not record it at 1 crore, we record it at 20 lakhs at the purchase price only. Okay, not at the market price. We record it at 1 crore when it is selling at 1 crore, not the present value. Okay, so this is historical cost. Okay, the original cost is a fact, it's verifiable, so we only record the historical cost. Okay, that is the historical cost concept. Next, dual aspect concept. Wow, now this one is the heart of accounting system. Dual aspect concept. Now every single transaction has two sides. It's like a coin. Okay, if a business takes a loan of say 5 lakhs from a bank, it gets cash. Okay, so an asset increases, cash increases. Simultaneously it owes money, so a liability, a credit will also increase. Okay, something came in and obligation was created. This is the basis of the famous all debits equals to all credits. So debit equal to credit, that is the rule. Dual aspect concept is every debit will have an equal credit. Okay, so everything all has to stay in balance. That is how it works. That is on this basis only the accounting concept is also called as double entry bookkeeping system. Okay, that is every debit will have an credit. Okay, now the next one is, what is the next one, guys? We have accrual concept. Okay, now accrual concept is a little tricky but easy to understand. It's also very crucial to maintain accuracy. Okay, it means that income is recorded when it is earned, not when the cash is received, and expenses are recorded when they are incurred, not when paid. I'll repeat that. It means income is recorded when it is earned, not when cash is received. Expenses are recorded when they are incurred, not when paid. Let me tell you example. For example, income, expenses paid. Now for example, if you have to receive a salary for March, but the actual salary is paid on say June, July, will it be a salary for June, July or salary for March? For March, correct? So when it is earned, when it is supposed to be paid, that is what it is recorded. That is accrual concept. Now if you have to receive an interest, for example, we know about the interest concept. Okay, now if I have to pay an interest of 2% every month from January to say March or April, okay, 4 months interest I have to pay every month. Now January I didn't pay the interest, February also I didn't pay the interest, March I paid interest of 3 months. So will that be the interest of March? No, it is the interest for January, for February, for March. So every month you record, in January I need to receive interest from Swapnil, in February I need to receive from Swapnil, in March again I have to receive interest from Swapnil. Okay, so every month it's accrued. That is the accrual concept. Okay, this basically matches income and expense to the correct period. Okay, this, just to give a true picture of profit. Okay, right. Now these were the core concepts. Okay, all these 7 concepts are the core concepts. Okay, those are the basic rules of the game. Now let's actually go and look at the conventions. Conventions are basically some practical guidelines. Okay, now the first guideline is conservatism. Okay, conservatism is also called as prudence. Conservatism means basically, you know, be cautious. Okay, we have to be very cautious. So this is what conservatism is all about. This is an guideline. Okay, now when faced with uncertainty, when in doubt, accountants generally choose the option that is least likely to overstate profit or assets. Okay, if we overstate the profits, it will not be good. Okay, so we need to choose the least likely option to overstate profits. Now it is like, you know, we need to hope for the best but prepare for the worst. You anticipate possible future losses, but you don't count your chickens before they hatch. Okay, now these prevent companies from looking overly optimistic and build trust. We should not be overly optimistic. Okay, we have to be very cautious. Okay, that is conservatism and prudence. Now second, which is after conservatism, the second one is materiality. Now this is about materiality. What does materiality means? It means significance. Okay, so accountants should actually focus on information that is significant enough to influence someone's decision about the money. Okay, so it should be significant. If for example, if a big company like Tata Motors will report spending crores on a new factory, okay, but on the same factory, if they are spending some tiny money for some pens and pencils, okay, that need not be reported in a separate line. Okay, so they can actually put it in miscellaneous expenses. Okay, they won't create a separate line item for pens and pencils when they are creating a factory. Okay, so because that is not material, that is too small to matter for big decisions. Okay, so the materiality concept basically says only significant items needs to be recorded and maintained. Now what is material actually depends on the size and context of business. Okay, for example, in the last example, when I say pens and pencils for Tata Motors might not be significant, but it might be significant for some other company. Based on that company's size, okay, it would, and the context of the business, you can decide what material is. It keeps reports very clear and focused. So we need to, the only thing is we don't need to create a separate line saying pens and pencils. We can put it in miscellaneous. Okay, no one need to know why, you know, if for example in Tata Motors example, we give say 5,000 rupees as miscellaneous expenses. We just write 5,000 rupees miscellaneous expenses. Now that can be divided in miscellaneous expenses. 100 rupees went for tea. Okay, 200 rupees went for, you know, some gum or something. We don't need to record that. 5,000 rupees miscellaneous expenses, that would be sufficient. But for major expenses, for example, if you are paying bricks, for bricks if you are paying say 2 crore 3 crore rupees, we need to mention for bricks it is material, so we have to mention it. That is materiality concept. Next is, after materiality, we have consistency. Now consistency, as the word says, what do you actually what comes to your mind when we say consistent? Consistent means, we need to maintain the same logic every time. Okay, now imagine, for example, you are trying to track your weight loss. Okay, but if you use different weighing scales every day, you will not know the change if it was real or just the scale. Okay, so that is why we have to maintain consistency in accounting. Okay, businesses should always use the same accounting method from one year to the next. This basically allows for fair comparison of performance over time. Okay, if they have to change the method of accounting, they will have to state it clearly in their accounting notes. Okay, but we have to maintain consistency. For example, if I am treating salary as expenses now, tomorrow we can't treat salary as something else and put as salary. In accounting, no, we can't. If you are treating amount paid to this guy as salary, you have to treat that as salary. That's it. Okay, next month if you want to treat that as no, to this account, this guy, if you are paying money, don't treat that as salary, let us treat that as something else. Okay, we should not. We should always treat that as a salary. So consistency has to be maintained for any business rule. Whatever rules you are making, that rules have to be consistently maintained. Okay, now the last one is, what could be the last one? That is full disclosure. Okay, now this means the company should report all relevant and important information that users need to understand the financial picture. Okay, now what happens is, there are a lot of things which are going on in the company. As an user of the financial data, as an owner or investor, I need to know certain details. Okay, those details have to be mentioned clearly. Okay, in financial statement there is something called notes. For example, if the company is facing a major lawsuit, if there is a case on the company, okay, it does not come in the financial accounts, because in accounts we cannot show, we don't know what the case, whether we will win it or we'll lose it, we don't know. But in the financial statements, in notes part, we have to mention that there is a case, there is an ongoing lawsuit on the company. Okay, and we have to mention how much, if we are losing it, how much we will have to pay. If we are winning it, how much we will get. That has to be fully disclosed in the disclosure notes. Okay, that's just an example, but whatever relevant information, whatever important information, for example, GST notice or income tax notice, if GST notice is come, not necessarily we will pay it right now, but we might file a case, we might file a suit, we are fighting for the GST. If we are fighting, we are not paying it, it will not show in accounts, but it should be disclosed in the notes as per this rule. As per full disclosure rule, it is an important information to be given to all the users of accountancy. So in the notes they have to mention there was an GST notice for so much. Okay, we have filed a case. Okay, that is about full disclosure. Now, okay, so now this is all it is. You see, these concepts and conventions aren't just random rules. They basically form a framework to ensure that the financial information the businesses provide is reliable, relevant, understandable and comparable. Okay, reliable means it should be trustworthy. Relevant means it should be useful. Okay, understandable means even for non-experts it should be understandable, and comparable means over time we can be able to compare it either with ourselves or with others. Okay, they basically build trust and allow people like you and me to make sense of the financial world. Okay, now that's it, guys. That we done. Okay, now that was a quick tour of the basic rules of accounting game. I hope this basically made things clearer and less frustrating or intimidating. Okay, now if this video has helped you, please hit the like button and subscribe to our channel. Okay, if you have any questions, maybe an example of these rules you have seen in real life, let me know in the comments below. Thank you for watching, and I'll see you next time. Thank you guys.